Before we get to what's going on in the public markets, I do want to ask you about the private markets. I'm not going to ask you specifically about Twitter, but there's been so much activity in that space, both in terms of, I think, what preceded this current economic environment, but I feel like that's actually beefed up a little bit more as people sort of look for something that offers, if not safety, maybe a little bit more of a better return profile.
Well, that's right, Romain. If you look at the performance of the private markets last year, for example, you had your classic 60-40 portfolio that was down 17%, but if you had a combination of private equity, private credit, private real estate, you were up close to 4% throughout the course of the year. So that's one of the things that made a lot of investors think maybe I should have some private markets in the portfolio. But even this year, despite all the volatility in the equity markets, you're still getting investment activity that is coming back in private markets, and valuations are correcting, but they're not correcting as drastically as they did in the public markets last year.
Well, that's what I'm curious about, particularly when it comes to price discovery, whether you're trying to price out a public equity or you're trying to price something in the private market. Given the uncertainty around economic conditions, uncertainty around the Fed, uncertainty around the debt ceiling, how difficult is that to do right now?
Well, it is pretty difficult to do in public markets, and I think that's why we continue to kind of hang around these current levels because, on the one hand, not to be an economist here, but on the one hand, you've got, the economic environment that's still okay, so that's supporting the markets, from the floor perspective, but at the same time, we worry about the debt ceiling and whether the road to resolving that is going to get rocky, and we worry about the banking turmoil because it's not really fully resolved yet. So I think that's capping the upside, but again, to the extent that those two events end up being choppy, I think the markets may have to react to that. And if you are a private market participant, of course you worry about some of that, but you know what? You're not selling these companies today. You're selling these companies 4, 5, maybe 6 years from now. And so you don't have to price in all that near-term uncertainty. And I think that's why you see a much smoother ride in private markets.
Yeah, there'll be like 2 or 3 debt ceiling standoffs before you look to sell those private assets. Speaking of the debt ceiling standoff, how are you seeing the concern expressed in markets right now? Because this presumably feels like it's going to be worse than in 2011. Does the pricing in the market back that idea up?
Well, it's very different where in the market you look at, Scarlett, because if you look at the credit default swaps, if you look at the 1-month CDS for U.S. government debt, it has actually surged to levels well above what we saw in 2011. And so I think, some market participants are definitely expecting a pretty bad standoff. But at the same time, if you look at the equity market volatility, first of all, there is very little volatility in terms of realized volatility on a day-to-day basis. But if you look at the term structure of volatility, there are no kinks. We're not seeing, volatility implied, around June 1st deadline. Really, we don't see any spike. So that tells me that the equity market participants are not as worried about it. And maybe that makes sense because I don't think anybody in their right mind thinks that we're going to actually default on the U.S. debt. And so that's why there's this kind of, relaxed attitude about it.
I was just trying to look through some of the data, and it did seem like we did see this pattern in 2011 where it kind of took till we got to sort of mid-July before you really started to see the real repricing of things. And then, of course, then we got to the downgrade in August.
Right, which came after the fact, after it was resolved. So how do you recommend investors seek shelter from all this, from what could be a messy period before there is a resolution?
Yeah, so a few things. I think there is a bit of a fear of missing out that has returned to this market. And if you had this fear after a strong start to the year, I would say now is probably not the absolute best time to jump in because we do have some of these risks that are yet to be resolved. And I do worry that, like in 2011, as we get to the 11th hour, the volatility spikes and equity markets can correct. So, you don't want to position and, add to equities right ahead of that. If we do get the pullback, I think that's a different story. And you start to pick up the pieces. But overall, Scarlett, I would say, investors really have this kind of amazing setup right now because you can be on the sidelines, you can get 5% yields, 6% yields, 7% yields, or 11% if you're talking about private credit. So you can get paid, wait out this uncertainty, and so we continue to recommend that investors do that. But the other thing I would say, I've liked tech, and I'm probably always gonna like tech. But if you look at the Nasdaq, just month to date, Nasdaq is up 1%. The S&P is down something like 0.8%.
Yeah.
And I think that tells you that because of the big tech names in the Nasdaq, investors continue to seek shelter there. And I think that continues.
Yeah, it's insane. Meta is up something like 100% just on a year-to-date basis. And I think a few others are in that camp, like NVIDIA as well here. But that's not really a bet on growth, or is that more just defensiveness?
Some of it is a bet on growth. Some of it is, shelter from, the fortress balance sheet, right? If you think about, where the balance balance sheet the strongest, it's big tech. Where you don't have a whole lot of interest rate exposure to, let's say, floating rate debt, again, that's big tech. You have higher margins in a lot of tech names.
Dominant market share to boot.
That's right, and secular tailwinds, right? So you've got cloud, you've got AI now, and that's really benefiting the big tech names.